Open any trading platform and you are hit with a wall of noise. Prices spike, crash, and jitter across the screen like pure static. There is a common belief that navigating this requires complex mathematical algorithms or some kind of natural-born fortune-telling ability. But professionals do not trade based on the news, and they aren't trying to predict the future. They are simply watching what people are actually doing with their money in real time. When you translate that chaotic line into this structured grid, you are looking at the body language of the market. Mastering this visual language turns that initial noise into a legible story of supply, demand, and the emotions of the crowd. To understand the chart, start with a single candlestick. Think of it as a 1-minute or 1-hour boxing match between buyers and sellers. Green candles mean the buyers won and pushed the price higher. Red means the sellers took control and drove it lower. The size of the candle body tells you exactly how decisive that win was. Look at the common doji on the left. It has almost no body at all. This shows us a match that ended in a perfect tie. The market opened and closed at the same price, signaling extreme hesitation. Then you have the engulfing candle. Notice how the large green body on the left completely swallows the previous red one. This represents a sudden, massive shift in power, where one side has totally overwhelms the other. Identifying where a fight stalls or shifts provides a baseline for tracking market intent. You aren't memorizing patterns as much as you are recognizing when one side of the market has lost its conviction. A single snapshot gains its meaning from the surrounding context. To see where the market is actually going, we have to look at the broader trend. An uptrend is like climbing stairs. As shown here, price creates higher highs and higher lows. A downtrend is the inverse. On the right, price creates lower highs and lower lows as sellers take control of the long-term direction. Financial markets also have floors and ceilings. Support is a price area where buyers step in to stop a fall, while resistance is a ceiling where sellers push price down. Because traders remember levels, notice how old resistance flips to become support once price breaks through. This leads to the golden rule: trade in the direction of the mass movement. When the majority of capital is pushing a trend, betting against it is a high-risk gamble. Without the collective power to stop that momentum, a lone trader's account is usually drained by the very trend they tried to fight. You can also adjust the scale of these charts, so a single candle represents anything from 1 minute to an entire day. These are called timeframes. This is like using a map. The daily chart on the right shows the major highways and the long-term trend, while the 60-minute chart on the left zooms in to show individual street turns. The practical rule is to use the higher time frame to find your general direction and the lower time frame to pinpoint your exact entry into the market. Trading strictly on this raw price movement without relying on cluttered indicators is called price action. We can apply these tools to a raw chart to see how a sequence of bars reveals specific human choices. We start with the macro story. This chart shows a clear downtrend of lower highs and lower lows. As the price approaches a previous low, we draw a support line where buyers have historically stepped in. Right at that floor, a doji candle forms. Sellers have stopped their aggressive push, and the market is suddenly hesitating. Immediately after that hesitation, a green engulfing candle appears. It shatters the downtrend line, signaling buyers have officially reclaimed control. No chart predicts the future perfectly, but by treating price action like footprints in the sand, you transform trading from blind guessing into an educated decision based on real human behavior.